Too many business owners who have been around the block still do not understand that banks are not what they used to be. The time when you had a personal relationship with your bank manager is long gone, despite advertising insisting on the opposite by most banks. It's unlikely that any traditional style manager and other bank employees who understood their communities and small to medium enterprises they serve still exist. People should accept that banks are only out to maximise profits, that bank shareholders want a maximum return on their investment no matter what the perception of the bank is in the marketplace. Once you understand that it's easy to predict how banks are going to treat you, if you are a small to medium enterprise, do not expect anyone to understand or care about your business plans or ideas. All they will ever look at is the security that you can put up to support your claim and cover the loan when things go wrong.
Although this chapter is called Don't Borrow Money from a Bank, I'm actually referring to your business. How you borrow money from the bank and put it into your business is the important fact of this chapter. But let's talk about how banks lend money to businesses, and I'll talk about why that's not necessarily a good idea for you. When you approach a bank for a loan for your business, let's first make the assumption that banks aren't going to lend you money unsecured. Banks are going to look for security, and the main security they're looking for is usually a family home or other real estate. This means that you are going to pledge your home for a business loan. In point of fact, in taking a business loan, what you're really doing is taking out another mortgage on your property. Banks will look for the security, they'll look for who owns that security, and they'll also look towards who owns the company. So let's say, for example, you have a property worth $700,000 and you have a $200,000 mortgage. If you go to the banks and ask for, say, another $100,000, which in point of fact is taking your mortgage from $200,000 to $300,000, the bank will probably happily lend you that money. But it works this way. That $100,000, which in effect is a mortgage, is linked to your business, and the bank will take a fixed and floating charge over the company, as well as security over your home. So what they've done is they've lent you once, they've lent you one lot of $100,000, and they've secured themselves twice against your home and against your business. And now your real problem is that not only are you, but your business is now tangled up with the bank. The documents you sign on a fixed and floating charge for the security can often be very onerous and give the banks all sorts of power over your business and you if you get in trouble. There are some problems in borrowing money from a bank in the way that I've described. Firstly, many of the loans are short term, say 5 years. So while your business is being successful, and you need every possible dollar you can get, the bank wants their money back. Or an overdraft, which in fact is a mortgage, gets to a high level or a high debt, and if your business is successful and you need more money, and you have no more security in your home, you're not going to be able to borrow any more money, and the bank will see you as having a core debt. In these trying financial times, if your business starts to get in trouble, the bank may call in their loan. They'll do this very quickly, and they'll insist that you go and refinance. Because your home is locked up with the business on this loan, it could be quite difficult to untangle your situation with the bank. The worst case scenario is if a receiver is sent in by the bank. A receiver is sent into your business so that they can collect the money for the secured creditor, who is the bank who holds that security under a fixed and floating charge. But hang on, haven't they got your money already from the value in your home? So what are you doing with a receiver in your company who is obviously turning it upside down to pay the banks back? But telling you about this is not what this chapter is about. This chapter is about telling you how to borrow money from a bank or a financial institution and protect yourself. So you're wondering exactly how you should borrow money for your business. Let's go back to the house valued at $700,000 with a $200,000 mortgage. It's also worth considering again how you've structured your company. Let's assume that a husband and wife or a partnership owns that house. One person can be the director of the company, and the other partner can be the owner of the house. In some states in Australia, you can actually have a natural love and affection document that allows for this to occur just as the business starts or just before you borrow money. In other states, you can get a binding financial agreement that makes for one partner to have all the equity in the house and the other partner to own the business. So if you've got a house worth $700,000, $200,000 mortgage, it means that you've got $500,000 worth of equity that you can borrow. So this is how we think that you should borrow money from a bank. You go to the bank and you ask for the money for yourself. If you walk in and start talking about your business, you'll go down the other line where they'll want to lend money to your business and secure the business and the house. But you're looking to borrow the money, and you being the partner that owns the house. It's good equity. If you can prove your income, then you should get the loan. The partner that owns the property that has borrowed the money will now lend that money to the company and also take a fixed and floating charge and step into the shoes of the bank and become the bank of the business. This is so important. In running Your Business Angels for 16 years, I've seen so many disasters that could have been averted if the partner who owned the house or the people who owned the house carried their own security over the company. It's their own money, so it should happen. I also believe too that non-conforming lenders are not a bad option either. Yes, you have a higher interest rate, but you can protect yourself. I'll say that all again. If you own the property, you borrow the money, not your company. Now you lend the money to your company and you carry a fixed and floating charge, which a good commercial lawyer can assist you with in putting that over the company. Now this is the way you should borrow money from a bank, not your business. While this may seem difficult and fanciful, borrowing money yourself or your partner borrowing money and lending it to the company with the other partner as a director certainly makes a big difference when things go wrong. Simply, the partner who lent the money to the business and holds the security has the ability to send in a receiver and claim the money first before all other creditors. This certainly means that by using the family home and investing it in the company, you have protected yourself as much as possible. I've already discussed with you ways that you should borrow money from your property to lend to your own company. But here's some other ideas when it comes to dealing with banks and financial institutions. Firstly, don't discount non-conforming lenders. Yes, the rate might look a little bit more, but non-conforming lenders are really only focused on being repaid every month. So while you're sorting out turmoil in your business, as long as they're getting paid, they're not going to interfere. If you're borrowing money from a primary lender, I suggest that you borrow money for vehicles or equipment finance from another lender. Don't put all your eggs in one basket when you're borrowing money. I also urge you to consider, if you're working business to business, to look at factoring. Factoring has in the past had somewhat of a nasty name, but to me it's one of the best ways to borrow money. If your business needs money, which is that you have a large debtors ledger, you cash up. As you get paid, your loan disappears. The most important thing in borrowing money for your business is make sure that you are doing proper cash flow projections. Don't kid yourself, don't lie to yourself. Good accounting, good cash flow projections are all going to help you plan to borrow money to make the best opportunities as they arrive. So, if you're going to deal with a bank and you have an asset, please be careful.